Hello friends and welcome to another video by the Option School, Basics of Options Trading. This is part 2. We have decided we will do this series of basics for the benefit of all the traders. Hope you have enjoyed part 1 of Basics of Options Trading, in which we have discussed about what is the difference between derivative markets and cash markets. Let us learn from scratch, and in this part 2, as promised, we will talk about what is call option and we will give you few questions, and let us see if you can answer those questions, which will let us know what is the understanding. So let us move ahead in our learning of basics of options trading. Okay, if you have not subscribed to the channel, please go ahead and subscribe to the channel. When you are subscribing to the channel, please press that bell icon also, so that whenever a new video is uploaded, you will immediately get the notification. If you are already a subscriber, go ahead and press the like button. Last video we left at the point, what is call option? We said it's a right to buy but not the obligation to buy. Now we need to be very clear, what do you mean by right to buy and not the obligation to buy. And you must know that okay, all F&O trades, all futures and option trades are futuristic in nature. Futuristic in nature means we are doing trade for some future date. You must be knowing there are expiries, like for July series the monthly expiry is on 30th of July. Today is 5th of July and on 30th of July there is expiry. So it means we are trading now for 30th of July. So which is 25 days from now. So today is 5th July and let us say there is a person, Mr. A, who wants to buy an asset from Mr. B on 30th July. Again, this is a futuristic transaction. Today is 5th July only. Mr. A wants to buy some asset from Mr. B, not today. He wants to buy that asset, let us assume, on 30th of July, which is 25 days from now. Now, what difference it makes? The difference it makes is that within next 25 days the value of asset can change. It can go up also, it can go down also. So let us say the present value of asset what Mr. A wants to buy is rupees 10,000. Mr. A gives rupees 150 to Mr. B and got a commitment that he will buy the asset on 30th July in rupees 10,000. 10,000 is the present price of the asset. So Mr. A gives 150 rupees extra to Mr. B. In a way, what he has done, he has booked the asset with Mr. B, that okay, Mr. B, don't give it to anybody else, you give it to me. I am giving you 150 rupees today and I will come to you on 30th of July and I will buy this asset from you. Mr. B accepts that 150 rupees and agrees for the deal. Deal is that Mr. A will buy the asset in 10,000 rupees. Now what has happened in this case? Just to understand what is right to buy, Mr. A has purchased a right to buy the asset in rupees 10,000 on 30th of July by paying rupees 150 today on 5th July. He has not purchased the asset, he has purchased the right to buy the asset. By giving 150 rupees, he has booked that okay, I will be buying the asset from you, Mr. B. And in any transaction, whether it is in stock markets, options trading or anywhere else, in any transaction a person can buy only if some person is selling. So every transaction will have two faces. One is there is a buyer and other is a seller. If Mr. A has purchased a right to buy, then there must be somebody who is selling the right to buy. So Mr. B has sold the right to buy. Mr. B has not sold right to sell, right? So that is the biggest confusion generally people have. Mr. A has purchased the right to buy. Mr. B has sold the right to buy. The person who is giving money is buying something. Mr. A has given 150 rupees. The person who is receiving money is selling something. Mr. B has received 150 rupees. So he is selling something to Mr. A. He is not selling the asset, but he is just selling the right to buy to Mr. B by to Mr. A by accepting rupees 150. Please note, Mr. A has not purchased the asset as of now. He has just purchased a right to buy the asset. What we said, call option is a right to buy. So in this case, Mr. A has purchased a call option. Mr. B has sold a call option. So far, transaction for asset has not happened. Let us see what do we mean by not the obligation to sell. Now on 30th of July, which is the expiry date for the contract, there can be different scenarios. Scenario number 1, actual price of the asset is 11,000. Remember, when the agreement is done on 5th July, the actual price of the asset is 10,000 only. Now on 30th July, let us assume actual price of the asset is 11,000. Now Mr. A will buy the asset because he already has a right to buy by paying rupees 10,000 only. He will pay only 10,000 because he has purchased the right to buy the asset in 10,000 rupees. So total cost for Mr. A will be 10,000, which he will pay now, plus 150 premium which he has already paid earlier to book his asset. So total will be 10,150. That is the cost to Mr. A. The price of asset right now is 11,000. Mr. B has to sell this asset at 10,000 rupees because there is an agreement and he has already accepted 150 rupees. So he is bound by that agreement. Now cost for Mr. A is 10,150. Now the actual price of the asset is 11,000. What is the profit for Mr. A right now? Hopefully all of you are able to find that out. 11,000 minus 10,150 rupees 850 is the actual profit for Mr. A in this scenario. Right? Let us see what can be another scenario. Another scenario can be actual price of the asset on 30th of July is only 9,500. Now what will happen? Can you tell me what will happen now? Whether Mr. A will buy or not. Remember we said Mr. A has purchased a right to buy, but there is no obligation on part of Mr. A to buy. Now Mr. A will not buy the asset from Mr. B because the price has gone below 10,000. There is no obligation or compulsion for Mr. A to buy. He will leave it as it is. He will say, Mr. B, I am not going to buy it from you because market price of the asset is now 9,500. I will go to the market and buy it in 9,500. Why will I buy it from you? If I buy it from you, I need to pay 10,000 rupees. If I buy from the market, I will pay 9,500 rupees. So I will be saving 500 rupees in case I buy it from the market, and I have purchased the right to buy. I am not using my right and there is no obligation on me that I need to buy an asset from you. So Mr. A will not buy the asset. Mr. A will forego his 150 rupees, which will be loss for Mr. A. So Mr. A, when he had entered into this agreement, his belief was that the price of this asset will really go up. That is why he blocked that asset at 10,000 rupees. Now his analysis has gone wrong. The value of the asset has not gone up, but the value of the asset has gone down from 10,000 to 9,500. So Mr. A has to bear some loss. So Mr. A is bearing a loss of only 150 rupees. Now what is the learning in this? If Mr. A has purchased the asset on 5th of July and on 30th of July the value of asset has gone down by 500 points, Mr. A would have lost 500 points, 500 rupees you can say. But now he has lost only 150 rupees. If the asset price has gone up, Mr. A would have made the same benefit minus 150 rupees. So by entering into a call option rather than doing a straight away purchase of the asset, Mr. A has leveraged his position. He has given only 150 rupees. He has not given 10,000 rupees. Part 1. Part 2. He is not participating in the loss. So suppose the value of asset has gone down to 9,000. If he has purchased the asset on 5th July, he would have lost 1,000 rupees. Now he is losing only 150 rupees. Whether the value of the asset goes down to 9,500, 9,000, 8,000, he will not lose more than 150 rupees. Mr. B will make a profit of rupees 150 and his asset is with him only. Mr. B has not given away any asset to Mr. A because Mr. A has decided he will not buy from Mr. B, but Mr. B definitely has made a profit of 150 rupees, and his asset is still with him. So the total loss on his asset from 5th July to 30th July is 500 rupees, out of which he is compensated by 150 rupees. So actual loss to him has got slightly reduced, right? So he has made 150 rupees as a net profit, where he is not parting away with any of his assets. So let us summarize this transaction. Mr. A purchased right to buy. So right to buy, we said, is a call option. So Mr. A in a way purchased a call option. Mr. B sold the call option. If somebody is buying something, obviously there needs to be a seller. Every transaction needs to be a buyer as well as seller. Premium of call was 150 rupees. Mr. A paid 150 rupees on an asset which was worth 10,000 rupees. He said, I will buy in 10,000, but I am giving you 150 rupees right now. So that was a complete premium which Mr. A paid to Mr. B to book that asset. In case the asset value goes up, Mr. A will be having a huge profit. Remember scenario 1, in which the asset price has gone to 11,000. So Mr. A would have made a profit of 850 rupees, but his maximum loss is 150 rupees only. So when you buy a call option, your maximum profit can be unlimited. Your maximum loss is limited to your buying price. Expiry of call was 30th July. All derivative instruments will have a fixed expiry date. You cannot extend the deal beyond that expiry date. In this case, 30th July is the last date. This agreement will be null and void after 30th July. So whatever is the profit or loss needs to be settled latest by 30th of July. And another important concept here, strike price. Strike price of call which we were talking was 10,000. So when you are trading in options, you must be 100% clear what do we mean by strike price. Let me give you a little bit of more information on this. We must understand the concept of strike price. There are different strike prices which are traded at different prices. When you are trading in cash, there is only one price. When you are trading in future for a particular expiry, there is only one price. But when you are trading in options, there are many different strike prices. In this example, if I extend it, Mr. A says to B that, Mr. B, I am ready to buy your property in 10,050 instead of 10,000. In that case, instead of paying a premium of rupees 150, I will pay rupees 120 only. Mr. A said, Mr. B, the property value is 10,000, but I will buy it from you on 30th July at 50 rupees premium. 10,050 I will buy, but today for booking the property, instead of paying 150 rupees, I am paying you only 120 rupees. And Mr. B agrees for this. He said, okay Mr. A, no issue. So on 30th July, you can buy my property not in 10,000 but 10,050. But today, instead of paying 150 rupees, you are paying a premium of only 120 rupees. Now total cost for Mr. A, if he goes ahead and buys the property, is 10,050 plus 120, 10,170. Earlier it was 10,000 plus 150, 10,150. Just see this fine detail. Earlier cost to Mr. A was 10,150. What is the benefit to Mr. A in second case? What is the benefit to Mr. A in second case? Uh, he will end up paying rupees 10,170 instead of 10,150. So why Mr. A has suggested this kind of a situation? Another scenario is that Mr. A and B agrees for a strike price of 10,100. Mr. A says, today the property value is 10,000. I will buy your property in 10,100 on 30th July, but for booking this deal, I am paying you premium of rupees 100 only. In first case, he paid a premium of 150. In second case, he paid a premium of 120. In third case, Mr. A is saying, Mr. B, since I am ready to buy your property in 10,100 instead of 10,000, I will pay only a premium of 100 rupees, and Mr. B agreed for that. Now, there are three different scenarios which I have presented to you. In third case, total cost will be 10,200 if Mr. A goes ahead and buy the property. So in first scenario, the strike price was 10,000, premium is 150. In second case, the strike price is 10,050, strike price is at which Mr. A agreed to buy the property. But the premium he has reduced, he is saying I am paying premium of 150 only. In third case, he says I'll buy at 10,100, strike price is 10,100, premium is rupees 100, right? So you need to give me this answer in the comment section. If the value of asset is 9,500 on 30th of July, out of 3, 1, 2 and 3, which deal is best for Mr. A? This will give you a lot of clarity on what exactly do we mean by a strike price. So if on 30th of July the value of this asset, which is today 10,000, is 9,500, out of first, second and third, which deal is best for Mr. A? Please note there are different strike prices for any asset or underlying when you're coming to options trading. This is an important concept. Strike prices are at different gaps. Some strike prices will be at a gap of 100 points, some will be at a gap of 50 points, some will be at a gap of 20 points, some will be at a gap of 10 points. This is an important concept you must learn. So to learn this concept, I'll give you two more questions here. I have already given one question. You need to answer that. Question number 2 is, what is the gap in strike prices of options for Nifty? Just find it out if you don't know. Otherwise, most of times you may be knowing it. But it is good to learn that okay, there is a fixed gap in the strike prices of Nifty. What is that gap? Is it 100? It is 200? It is 50? It is 25? What? You need to answer that. Third question is, what is the gap in strike price of options of Infosys? So Infosys is another popular stock. So find out what is the gap in the strike prices of Infosys. Is it same that as that of Nifty, or is it different from that of Nifty? So you have three questions to answer in the comment section. Question number 1, question number 2 and question number 3. Just write it in the comment section. What is your answer for question 1? What is your answer for question 2? What is your answer for question 3? This will help us to know whether you have understood the concept or not. If required, we will try to explain it in a different way, so that main purpose is all of you completely understand the concept of options. So today we have completed understanding of call option, and in our next video we will be talking about what is put option, what is the physical meaning of put option, and similarly we will ask you some practice questions. Now whether we continue in this series or not, it totally depends upon how all of you as viewers respond. If your response is good, if you are writing comments, if you are liking the videos, if we see decent number of views, then it really encourages us to continue this series. But if the response is not so great, then obviously we are not very much encouraged to continue the series. So it's totally in your hands. So like the video, write comments, share the video to somebody who is new to options, so that you see it gives us a lot of encouragement, and we continue doing this series for all of you. All of you who are have already gone through basics and they want to learn some advanced concepts, you can join our online workshop on 11th and 12th of July. We will be talking about basics, Greeks, and lot of strategies and their adjustments. You can visit our website theoptionschool.in. For enrolling for this workshop, I will be showing you some numbers also, right? If you want to participate in our live chats, uh, which are for videos which are live at 9 p.m. on all working days, you can become our gold member. If you want to connect to us through WhatsApp and ask our views on your trades, you can connect to us by becoming a diamond member. And if you want to see some of our hedge trades, you can become a smart hedge member. How can you become a member? You can click on this join button and you will get all the membership details, and link is also given in the description of the video. To join our workshops, you can contact us on these numbers. You can send us a email also on this number, right? Feel free to contact us, and do like this video, Share this video to somebody whom you think it will be useful. Your comments are very valuable to us, so write your comments so that we can come to know whether the concept is clear or not. In the comments, not only the answers, but you can give your feedback, you can give your suggestions also. And if you have not subscribed to the channel, first thing we need to do is go and press that subscribe button and immediately subscribe to the channel. So see you in our next video on what is put option. Have a great day. Thank you.